healthcare is the one that's holding up the best now. I guess like
Yeah,
the
man.
RFK stuff is kind of blown over. The market doesn't really care about those risks anymore.
Nah, it definitely pretty interesting because it's almost like, see, it hasn't given a bullish trend yet, but it did actually bottom pretty sharply on the slowdown pivot. We pivoted to slow down to risk off here and then slow down afterwards, and it just kind of has gone up.
Yeah.
But like it hasn't really. It's hard because it's like it's gone. It did a small a quick burst, and then it's gone sideways for almost a month now, exactly. So it's not really any material gains here. But it's just interesting to note that like they did bottom into this and kind of like ramp into the slowdown a bit. So it's obviously it's obviously happening under the surface, but it's just not um it's like prolific enough for us to take advantage of it is all.
Yeah. I guess the slowdown just wasn't strong enough for the system to pivot into it.
Yeah.
I feel like the next phase is deflation. Like that seems like the most likely scenario because
You think?
most deflation regimes are led by stagflation. It starts off as stagflation and then it turns into deflation. But
Yeah.
I'm not seeing commodities really moving down too hard. Like today they actually like GSG held up pretty good today.
Yeah, for what happened, it definitely did. Um I mean, the commodity index, the GSG is off highs, right? But our inflation index is down quite a bit. So
Yeah.
it's almost like teetering on the line of like breaking trend. Well, I don't want to say going under. It's entering the territory where it could start playing with the idea of flipping trend. Which, man, listen, that's an interesting development, right?
Yeah. And it's funny because it was just as so many people are calling for another inflation wave.
Dude, I know.
And we're just
It's pretty funny.
most likely heading into deflation, which is pretty crazy.
Yeah, I do think that there will be some developments that need to happen for that move to deflate. Like, I think in reality, like for us to get like an actual deflationary shock in the market, commodities are going to need to be like down. Like, I'm not talking like, 20 like Momo. Like commodities should be at the lower end of the 52-week range.
Yeah.
So I think like maybe we get a deflationary print in the system or something like that, right? Maybe we get something up here, but I don't think you're gonna have that traditional like. Well, I don't want to say that because like if commodities fall from 22 to 20 real quick, that will be a deflationary shock, right? So it's not that we have to get down there, but in the process of getting a deflationary print, commodities should go down. If they don't, then the deflationary regime is likely short-lived.
Yeah. But then in terms of bonds and TLT, like they were just pricing in inflationary pressures not that long ago. And that was largely due to the deficit. And so that deficit inflation risk is now coming off the table. So it's not even like we really need deflation or strong deflation, even just that deficit risk coming off the table and some disinflation coupled with that, and with the Fed being still at 5%, I think bonds can move up like well before we even get deflation. Like
Well, do you
it could
do you
continue.
do you realize what's going on here with bonds? The reason they're reacting so well to the deficit is because, like, from a perspective of the Fed and the Treasury, um, the fiscal has been pretty ridiculous, but like it's been on the back burner the last couple of years. It wasn't nothing. We knew it was just a given. Nothing would really happen with it, right? And the Fed getting to a restrictive stance is the most important. And we were pretty adamant about the Fed getting to a restrictive stance. Like I think we were. I don't know how hard we could have possibly pounded the table more than we did. The Fed was restrictive, and I think the issue there with the Fed being restrictive is that it was offset by the fiscal stimulus, the deficit, right? So, when you what you just said a few moments ago about us going to deflation, like we had this crazy 6% fiscal deficit going on, and inflation is in the twos. So what's going on here? The Fed is obviously offsetting that inflationary pressure. So what happens if the Fed stays still and fiscal evaporates? That fiscal stimulus starts evaporating. All that pressure the Fed was putting on the market to keep inflation contained at 2 to 3%, they're still there in the restricted state. But you remove that fiscal positive impulse, and then what ends up happening is, like bonds are starting to move up on, right? You get that shock where like you don't have that push to the pull, right? The Fed's pulling inflation down, fiscal's pushing it up. The fiscal goes away, and now you got basically two sides contracting on inflation and growth. So it's basically both parties pushing the economy in the same direction, whereas last year it was one offsetting the other, and that's the risk in the macro landscape right now.
Yeah. And they're really going to have to play their cards right and cut rates as that deficit decreases. Like we don't even know how quickly this deficit is going to decrease, and the Fed doesn't know either. But they're going to have to play it with that, and also with the lags that they have. Like it's not like they can just cut rates and everything's good. There's going to be at least a 6-month lag in every cut that they do. So they're going to have to kind of work ahead of that deficit reduction.
I think honestly that the only reason, like, you could basically argue the only reason the soft landing did occur the way it did, right? And yeah, I'm gonna call for it in the perspective that it happened. The soft landing happened in the past. It doesn't mean like there's not any macro headwinds going forward here. It was fiscal, right? The government was spending a lot of money. Like, let's break this down a step further. The the deficit is what backstopped a possible recession, and the Fed was basically what put the equilibrium in place to where we didn't see that rising inflation. It was kind of a mix of both worlds that aligned perfectly. Now, if you pull that deficit back, we don't know how much will impact, like, we don't know what the impacts are per $500 billion that they pull back on the deficit. Like, if they only cut the deficit $500 billion, what are the effects to growth, inflation? It's hard to tell, right?
Yeah,
Given the
and
Fed,
those
the
effects
Fed's
are
at
different depending on where the Fed is at when that happens.
exactly. And to sit here and say the Fed is going to perfectly time the pivot, like this has been we've been basically harping this since 2024, right? The Fed is going to somehow blunder this. Not sure exactly how. I mean, we longed 2024 pretty much most of the bull rally out. Like we made, I think we walked away with 30 something percent in 2024, right?
Yeah.
So we obviously killed it, but we still were of the understanding that there's going to be a slip up here from the Fed. Now, these deficit dynamics didn't really come into play up until as the election came closer and things started to become more clear. The tariff outlines became more solidified. Even they're still quite foggy, but they became more real than they were before. And this objective of Doge and whatnot all started to materialize. That's when I think the bond market started understanding what was going on, right? Because if you look at TLT, we go into the election, right, over here, and we get this initial pop and an absolute fade in bonds, like an absolute rise in yields. And as we start turning around from inauguration and things start getting lined up, or at least everyone's talking about these deficit cuts and everything, the bond market starts moving the other way. Mind you, like the unemployment print, not bad, right? Like if we look at the unemployment rate, look at this. Like it's gone the other way. Last print is at 4%, right?
Yeah.
Jobless claims, like just look at these, right? Let's see if we can pull these up. Jobless claims 242, but like they're up, but it's not like the summer. Remember in the summer when we were thinking about possibly going to like 275 on
Yeah.
these? Yeah, right. Like it's up, but it's not like sky high. You're nowhere near the cycle high. So you got to sit back and say, okay, like It's obvious that the market is concerned about this deficit and the possible negative effects, but like we don't know. Like if they trim 500 billion off the deficit, what impact does it have? And where is the Fed going to be able to foresee that coming? And I don't think they will. I think what's going to happen is the Fed is basically at this point. I think that they're going to have to cut, but it's not going to be the labor market that makes them cut because that moves way too slow at this
Yeah.
point.
Like the timing is so crucial with all of this.
Right. Like I wonder if it's at this point it might be equities that makes them cut. And it might be on the idea that liquidity is just drained at that point, right?
Why?
They start easing
Why do you think
because
equities?
well, equities going down or doesn't really mean much, right? Like equities going down is just one part of the equation. The reason that they're going down is there's a growth shock and a liquidity strain in the economy. That's what's going on, right? So the equities are falling. That's what happens in this situation. And then the Fed's like, okay, we need to ease up on the economy. We're too tight. And that might not necessarily mean that growth, that unemployment is sky high, right? Like there's a lot of, the problem is it's hard to factor. Like we're talking about shutting down immigration, right? So all the basically the injection into the labor force is being taken back, right? And you're talking about optimizing the labor force from government downsizing to private sector optimizations, and all of these things have ebbs and flow impacts in the economy, right? As they like push and pull across the ecosystem of the economy per se. And it's going to take some time, I think, for the unemployment rate to really just take off.
And so you
And
think the stock market's going to start pricing that in and price in a recession before the Fed starts cutting?
yeah, if that's how it's going to come into the market, yeah, I think the market's going to try and price in a recession before it shows up in unemployment data, because I just think that the issue is that we have obviously like okay, if you look at it from uh, a market cap to GDP ratio, like we're at like 100, basically 100% plus to GDP, the stock market's valuation, right? And the Buffett indicator here, let me pull it up. Okay. So if we look at the market cap to GDP ratio, right? It's not 100%, it's at 200%. Okay. And this peaked in 2021 at 190%, something like that, 195 ish, something in that ballpark. In 2000, it peaked at 132. Okay. So if you look at it from this perspective, equities are extremely overvalued. It doesn't mean we wouldn't buy them if we went into a risk on environment right now. And like, I'll get to that in a second. But theoretically, equities are very overvalued. The reason for their overvaluation is that the economy is overcapacitated, right? So what's going on is there is basically more stimulus going in the economy than what can possibly be utilized. And a lot of it's being absorbed into asset inflation, asset price inflation. Okay, so that's why you're getting these ridiculous 200% multiples. And what's going to happen is if you cut fiscal, that money getting injected in the economy is going to drop, and valuation should come back into reality to some degree, right? And in that scenario, the valuation correction might happen faster than the labor market even moves, right? Because like that excess capital is not being utilized. It doesn't have the possibility to be. If you look at it from an output gap perspective, right? The output gap is positive right now. Okay, so I think we have a chart somewhere we could show that. But if you look at the output gap, we're pretty up there on the output gap in terms of working with an economy that's running above potential. So if you start taking this deficit down and you start taking the stimulus out, you're bringing the economy down to potential, right? So you're not necessarily putting the economy into a recession, because when a recession happens, the economy is essentially running under potential, right? It's running under it's running under capacity, not over capacity, under capacity, right? Over
Hmm.
capacity is the output gap is positive. So when you go into a recession, the economy is rolling into a state of under capacity. Now, imagine a situation where we go from overcapacity to balanced. You're not necessarily in a recession, right? But your stock market, it's going to have your economy is going to have a lot less liquidity in it.
Yeah.
And the issue here is the stage and speed. Is if this needs to be prefaced. It's very, very important. Very important. This is assuming that they actually can cut the deficit. If they don't, I think the stock market will keep going up
Yeah. And
on the same.
it's not even just whether they can cut the deficit, it's how much they're able to.
Exactly. So let's get back to the point here, though, with the output gap, right? Like, let's just say we're going to go from a positive output gap to a neutral output gap. So there's no real output gap. Economy is essentially at capacity. In that scenario, right? If the Fed stays where they are right now, and we go from the positive level we're at to neutral, the Fed's level of restriction will amplify within the market without them doing anything. So they will have to ease accordingly to keep that equilibrium. It's a big, big mess here that they have to play. They basically have to counteract the reduction in stimulus properly to prevent the economy from running under capacity. What ends up happening is if you can fall and the Fed can offset it, what's going to happen is you're going to get the lower liquidity, but the Fed's going to offset it, and you're going to get some correction multiples, but it won't be as severe. If the Fed isn't able to offset it, you get that snapback from overcapacity to neutral and then right to undercapacity. And then you get the recession and the Fed's easing and chasing and trying to make up for lost time. So that when I say that I think that the market can essentially front run this idea of a liquidity crunch and maybe what we would call a recession, if the deficit is going to get cut, it likely doesn't start with the labor market. The labor market happens after the fiscal impulses blow through the market and blow through the economy and suck out all that liquidity.
Yeah. Wow.
The recession doesn't, the labor market doesn't break first in this situation, right?
Powell and the Fed, they had to deal with timing inflation perfectly, but this seems like a much harder thing to time.
It's definitely not fun. I mean, you could just look at it from look at Bitcoin, right? Like, thankfully we dumped this thing close to 100K, but like, this doesn't look too hot.
No,
And
that looks like liquidity draining and risk off.
right. And the question here is if this deficit stuff continues, right? A little Bitcoin summary is a lot of the reasons people buy Bitcoin, or most of the reasons that people buy Bitcoin, is this idea that it's a hedge against a runaway train. The government's going to keep spending. Listen, it's a bold thing for the president to say they're going to balance the budget in 12 months. A ridiculous thing to say. Do I think they do it? Probably not. Like, let's not play games. There's the odds of them pulling that off very low, especially with tax cuts on the table, right? Like, come on. Your tariff revenue is not going to make up the difference. Okay, let's just be honest. Given that the way that the economy is currently set up, the tariff revenue is not going to make up the difference. It can certainly add to the receipts, but it's just not
Yeah,
gonna
they got to
materially
cut
change.
out Social Security and healthcare to really make a significant dent in the spending, which
And
there has not been a mention of doing that at all.
but this is the problem, right? Like, so look, this is the risk in macro right now. Let's just say Doge cuts, I don't know, 150 billion in the first 2 quarters, right? The market will extrapolate that. But what happens if in the next 4 quarters they only cut 50 billion? Right?
Mm.
So what ends up happening is you have this market that is like, oh my god, linearly price a deficit path based on what Doge or what the government's able to achieve in the first measurement period. And what happens if the progression from that period are only a quarter of what they've achieved prior, right? So think of it like an exponential fall off. And the market's not going to wait to figure that out. We're going to start acting as if the Fed is really in a restrictive state and the deficit's really coming down, and the market's going to move in that direction. And what ends up happening is you run into this situation where if the market finally realizes that that deficit's not going to get cut and it overprices it, you're going to get a snapback, a very hard snapback. Because remember what I said earlier, the labor market's getting shaken out here, but it's not necessarily like theoretically, if you took the government employees, even if you fired half the workforce, right, of the government, you're not necessarily going to materially blow out the unemployment rate. You need the private sector, or I should say, you need the private sector to have an acceleration in unemployment. The DC workers alone aren't going to break the labor market. So you need like a broad spread systematic labor issue. And for that to happen, I think we need to see this deficit come down. So it's like the deficit should start coming down, and then that happens. And theoretically, the way markets work, as long as the markets think that deficit's coming down, they'll start acting accordingly. And like I just said earlier, if the market starts realizing that it's overpriced a situation, that's when you get the snapback. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on X @TheMarketRadar or go to our website at market-radar.com.